Good evening. On behalf of the Ascension Parish Library, I thank you all for joining us for the third session of this Build a Better Business series, maximizing the benefits of tax reports for entrepreneurs. I'm pleased to present tonight's guest, Ms. Benita Rice. Ms. Rice has over 20 years of corporate experience working with C-level executives in several roles: asset management, management analysis, and project management. Also, next week, don't forget our last session. It will be held on Wednesday night, September 30th, on how to prevent your business from failing, identifying strategies and systems to grow your business. But for now, I'm going to go ahead and turn it over to Ms. Benita Rice.
Good evening, everyone. Thank you so much for joining us at tonight's, this evening session. It's only 6:30. And I'm just happy that you're here and look forward to taking your questions at the end of the session. If you have a question, please go ahead and type it into the chat. Hopefully I'll find the chat button, and then I'll answer your questions. If not, I will respond to you by email. All right, so welcome to learning how to help your business keep more money through the taxation system. And no, it's not about showing a negative balance on your financial statement every year. It's about knowing the tax codes that are out there to help you as a small business, not just save money on your taxes, but acquire equipment and grow your business. So welcome. Okay, as the class is called Maximizing the Benefit of Tax Reporting. So I'm assuming that you are already reporting taxes. If you're not, please don't tell me. That's between you and your next tax person. But I do want you to know to maximize it, understanding, being able to identify and understand the different tax concessions that are available for you. So we're going to start first with business ownership classification. And the reason why we're going to start with ownership classification is because a lot of people, they're really not sure what this ownership classification thing means. That's exactly what I said, this ownership classification thing. You're not really sure what it means. So we're going to start from the basic form of ownership, which is a sole proprietorship. When I was a kid, that's all I knew was a sole proprietorship. Sole proprietor means that you're self-employed. That's what it means. You don't have a business name. You don't have an LLC. You haven't incorporated with the state. You're just out there making money, and you're gaining all this money, and you may or may not pay taxes, but you are earning money as an independent contractor. Okay? It's a sole proprietorship. Sole means one. So that doesn't mean that you and your wife together own this business. You're sole proprietor. That's not what we're saying. Sole means one, not two. Excuse me. Who owns a business that is unincorporated? That means it's never been registered with the Secretary of State. It could be someone who does odds and end jobs. It could be an independent contractor. Let's define what an independent contractor is. It's a person who's paying for the work, that has the right to control the work or direct the result of the work. So this is a very critical component, or very critical definition of what an independent contractor is. That's that 1099 employee that you have versus an actual employee. I should say that's that 1099 contractor that you have, the person you issue that 1099 to versus an employee. The big difference, let's get it together right now. If you are telling the person how the work must be done, they are an employee. That's what they are, an employee. If you are telling them how to do the work, they're an employee. However, if you're telling them what you want done and they have the ability to figure out how to get it done, they're in control of the work, they're held responsible for the output of the work, then that person is an independent contractor. Please remember that, because too many times people are getting caught up with the 1099 and they're really employees, and you give them a 1099. A lot of them aren't even filing taxes on that 1099. That's a whole other story that I didn't come here to talk about. So we're going to move on to the next type of company. Limited liability company, an LLC. Limited liability company. That means, as the name says, that you as the owner will have limited liability with this company. The company is going to provide a buffer between your assets and the company's assets, so that in the event that something goes wrong, the company takes the brunt of it and not you. A limited liability can be a single person entity. They're registered with the Secretary of State, they're registered with the IRS, they've given them a wonderful name with the words LLC after it, and they are now a registered entity, okay? Now, when you're an LLC, you can choose how you want to be taxed. Yes, you can. You can be taxed as a sole proprietor, meaning that when you're finished at the end of the day, all of your expenses and your revenue goes on a Schedule C or CEZ with the Form 1040. Okay, you can choose to be taxed as a sole proprietor, or you can choose to be taxed as a corporation, either an S corp or a C corp. When you tax as a C corp, the net revenues flows into your personal taxes. When you're charged as an S corp, or you choose to be taxed as an S corp, or the corporation is going to pay taxes, and any money that it gives to you is going to go to your Form 1040, and you're going to pay taxes on that money. That is called a system of double taxation. You need to speak to a tax advisor to decide what is best for you and your family. But let's go back over what the C Corp offers. The C Corp offers you 3 ways of filing. I'm sorry, the LLC offers you 3 ways of filing. An LLC, you can file as a sole proprietor on a 1040. You can file as a S Corp, where you file the S Corp tax form, but the net revenue rolls back over to your 1040. Or you can file as a C Corp. You have the option to file as a C Corp, where the corporation is going to pay taxes and you are going to pay taxes, both separate. Okay, they're separate owners. The entity is separate from you. I like to talk about the partnership, and then I'm going to switch back and talk about a little bit more about the protection that you get from owning a business that's independent from you. Let's talk about a partnership. A partnership files a Form 1065. It is created between 2 people. You cannot show up and say, I'm a partnership. Partner means 2, and it's 2 people who come together to agree to conduct a business. Now, there's usually LLC, which is the most common one, and then there's an LLP. Here's the problem with an LLP. An LLP is a limited liability partnership. When you get rid of a partner in a limited liability partnership, your business is now dissolved, okay? Because the partner is no longer there. So now you have to turn on and recreate a whole new business. With an LLC, if you have a partner, your business does not dissolve because the partner is no longer there. You can actually buy or sell that. You can actually buy that partner's interest and still remain an LLC. That partner can sell his interest to someone else and it still remains an LLC. You'll have to make changes, of course, with the Secretary of State. You'll have to make changes on your operating agreement, which many of you with an LLC don't have. But you'll have to make all these different changes, but you still have your LLC. With a partnership, just like an LLC, you're going to share the profit and the loss of your business. One of the differences, though, is that remember the LLC can file as a corporation, an S Corp, or 1040. With an LLP, they have to file a Form 1065. When you file a Form 1065, the partnership itself doesn't pay any taxes. All of those those income and the loss gets passed down to the partners, and they're responsible for paying those taxes, paying those income and paying the taxes on the income or claiming the loss. Now, the IRS have also instituted a new option, and that option is for the owner to opt out and say, hey, I want these losses to be addressed on an LLP level, on a partnership level. You can make that option, and it's very much a new option. But right now, as far as you're concerned, your income and your losses passes right down from the partner, from the 1065, and goes right on to your 1040 for each partner so that they can pay their share of the taxes. Now, in terms of a business, again, a business owned by spouses that's not incorporated with the state is not an LLC, and it's not a partnership. Here are the rules. If the husband and wife owns a business and share in the profit and the loss, they are a partnership, whether they have started a formal agreement or not. So my expression is that of yikes. You may not have known it, but guess what? If you are your husband in business, you have a partnership whether or not you're registered with the state or not. You cannot file a Schedule C or CEZ with the 1040. You cannot, you should not. You have to still file that Form 1065. That's a partnership form. So whether or not you filed with the Secretary of State and said that we are now an LLC or an LLP and we're husband and wives, as long as you're husband and wife, it's considered that you're a partnership. There's only one exception to this rule, and that is the spouses of people who live in community property areas. So congratulations, Louisiana. You are one of those states that falls under this community property law. In this particular situation, you can choose whether or not you want to file as a sole proprietorship or as a partnership. So welcome, Louisiana. You guys are miles ahead, along with Arizona, California, Idaho, Nevada, New Mexico, Texas, Washington, and Wisconsin. Those are the only community property states that allows you to file as a 1040, okay? So that's the only exception. Corporations. In a corporation, you exchange ownership for something of value, which is money, property, or stocks. Now, a lot of you go to Office Depot and you pull out those stock certificates and you write these wonderful words on it. Oh, this stock is worth 100 shares and it's valued at $10,000. And you slap that into your folder and you think that you have created a corporation with stock ownership. Something of value has to be exchanged for the stock ownership. It's not a brilliant idea. It's not a great thing to go get that paper. If you're going to give somebody stock ownership in your property, they must pay for it. They must provide you with money, property, or both in exchange for the ownership of the property. Here's the thing though. If somebody gave you $100 for $10,000 worth of stocks in your company, you have just devalued your business to what, 10 cents per share? So be careful how you go giving out these stock ownerships, because the price the person pays for those shares in your company is going to determine the value of the company. And you better take some money or some property or something in exchange for that ownership. Don't sell yourself short, okay? Put value on your stock so that when they pay for ownership into your company, it actually gives your company value and not reduces your company value. A corporation is treated as an individual and is taxed twice. I mentioned that before. I said with an LLC, you had a choice. You can opt to be treated as a limited liability company, an S Corp, or as a C Corp. And if you tax as a C Corp, then you're taxed twice. Once at the company level and another time at the shareholder or stockholder level. It's the system of double taxation. You're going to pay taxes, you're going to pay it twice. With a C Corp, a C Corp is taxed also on the dividends that they receive. So every company, corporation should be giving dividends to their stockholders. They should be, okay? And when you as the individual who owns the stock receive that dividend, you are taxed on it. However, if the corporation experiences a loss, you aren't taxed on that. You don't get the benefits of the loss. To you as the individual who owns the stock, you don't get to take the benefit of the loss that the corporation has experienced. So you get the benefit of the dividend, you're taxed on that, but when there is a loss, you don't get any benefit at all from that loss. The corporation can also decide that they want to be taxed as an S Corp and be exempt from federal income tax. That only happens for certain passive incomes and gains. You know, some of those things are excluded. But overall, they're trying to be exempt from federal income tax, just like the limited liability company back there. If they're exempted from federal income tax, that means the shareholder must get their share of the income, the share of the loss, deductions, and credit that the company is going to pass on to that individual. And they're going to report all these things on the 1040. If you don't understand, I'm sorry. I'm not seeing your chat right now, but I will check on it later. But those are the different types of business structures. And we're not counting nonprofit because nonprofit does not generate a revenue. They do not fall into the same category as those other businesses that we just talked about. So let's talk about tax deductions. Tax deductions are important. Tax deductions are important because a tax deduction leads to a reduction in liability. Okay, it leads to a reduction in tax liability. Okay, that's all it is. You get a tax deduction, it reduces how much money you pay to the government. Now we have the work opportunity credit. I'm going to go cover about 15, 16, maybe 17 different types of tax deduction that are beneficial to you as a company. I'm going to cover those things. I'm making sure that we are still recording. Okay, looks like we're still recording. All right. So the first one I wanted to cover is one that oftentimes people leave on the table. When you're a small business, all of your money matters. If you're going to hire somebody, you really need to have that money to pay that person a wage. And a lot of times I've heard small business say, I don't want to hire nobody because they don't want to listen. I don't want to hire these school children because they don't want to work. They want to come up in here with their pants sagging and they don't want to do no work. And you got to tell them everything to do. And I got to make this money. They're wasting my time. That's what I hear. But I'm here to tell you that there is an opportunity available for businesses to hire certain employees. And the government helps them out with the payroll part of it. So these categories or targeted employee categories are the veterans, people who are receiving family assistance, the summer youth program. So business owners hire a young man in your neighborhood, your community or two, and take advantage of this credit. The credit is available to pay 2 years of wages. First and second year wages of experience, okay? And sometimes they may say 6 months, or they may say, okay, we're gonna come alongside you and meet you somewhere in the middle. You pay some and I pay some. But the credit is a percentage of the employee's wages. You get a credit. That is a percentage of the wages of that employee. And that can range from anything from $2,400 to $9,600 and per employee. That's a lot of money that you're not taking advantage of. And to qualify, all you got to do is request from laworks.net and be issued a certification for each employee from the State Employment Security Agency, CISA, to prove that the employee is a member of the targeted group. So in order for you to qualify for this type of deduction, you have to go get a document from the state that says this employee is a part of this targeted youth. They are a veteran. They are a targeted group, I should say. I'm sorry. They are veterans. They are long-term family assistance recipients. They are summer youth program people. You go on in there, you prove it, and there you go. You will have help, the assistance that you need, and you will have not just physical labor, you will also have financial benefits from them, because they're going to help meet you along the way with the wages. And then you'll also have a credit that you can use on your taxes, your state taxes, I believe. Another credit you can do is research and development. I've run into so many people who have these really great have these really great ideas, who have developed really great products, and they don't realize that what they're doing is called research and development, that they are manufacturing. They're trying to get to the manufacturing point. But in the space between researching and developing this really great idea, turning it into a product, a service, or whatever, there is the option, well, not an option, there are opportunities for cost savings. So what that means is that all those expenses that you're putting into designing, your legal fees associated with getting it patented or copyright or whatever, the drawings, the prototype, all these things, all these expenses that you're incurring during the process of researching and developing these things, they are a deduction. They're a deduction on your taxes, okay? What's not allowed as an expense are the things that incurred during the testing, inspection, consumer management efficiency studies, and promotion, because those don't count as research. So the researching part, the development part of it is okay. But when it comes to doing the promotions of it and pushing the consumer studies, that's all part of the promotion of the idea. It does not count. However, I provided you a link at the bottom. I provided you a link directly to the IRS for more information as to how you can claim and be qualified for this deduction. So that's the research and deductions expense. The other credit that I'd like to introduce you to is called a credit for offering benefits to employees. A lot of times I see people who are making money. Excuse me, gotta take a sip. Thank you. Okay, so a lot of times I see people who are making money, they have employees, and they have great employees, but then they have high turnover. One of the reasons why they have high turnover is because every employee likes some type of benefit. They want to know that they can take a leave and get paid. They want to know that they can be sick and still have insurance, and it's not all the burdens is just not on them. And one of the credits that employees can get is to allow your employees to have access to family and medical leave. Okay, a business owner gets to claim a credit for the wages that they pay their employees when they're on leave. It starts at 12.5% for payments of half the salary, and it goes up to 25% if the employee is paid in full. Now remember, that's just a credit on the wages. That's not the wage, so you're getting a credit and a wage at the same time. And the maximum leave allowed is 12 weeks per year. So this is especially good for a business trying to figure out, how am I going to keep these employees? How am I going to offer benefits to employees? Here you go. This is a really great one. And it's so great because at the end of the year, you're paying all these extra money in taxes because you cannot afford to pay benefit. Whereas had you paid your employees some level of benefit, you would have been able to to claim a credit under the Tax Cut and Jobs Act. So please don't leave this one on the table. Speak to a benefit advisor, an HR professional, and learn more about how you can utilize this benefit to keep good employees around. Christmas is coming. It really is. There's no goose getting fat. My neighbor had goose and he told me that somebody killed them. So there's no goose getting fat in my neighborhood. However, your customers love gifts. Let's just face it, they're looking forward to loving and receiving the gifts that you give them. And oftentimes there's some confusion as to how to give the gifts. And you're like, okay, if I buy this gift, I cannot afford it. I cannot afford to spend this much money. I can't afford to spend this much money. It's not tax deductible. They're going to say it's not permissible. It's not allowed under taxes. But guess what? Here's another great thing that came out of the Tax Cut Job Act. I got to make sure I keep it in order, TCJA. And that is that you are allowed to give $25 annually up to in a gift to a person. So you know, if you're doing the right thing by checking your, looking at your financial statements throughout the year, maybe having your tax person run a tax scenario for you to see how much you're going to owe by the end of the year, you should be able to make certain adjustments. And one of the adjustments you can make is a business gift. You can give $25 annually as a gift because that's the maximum that's allowed per person as a deduction. Now, here's what is not counted towards the $25. Promotional items such as calendars and pens, they don't count towards the $25 limit if each item is $4 or less. However, that counts as general administrative expense, right? Yeah. So you can buy those items, mark them down on your general and administrative expense, and still have room to give a $25 or less gift. You can also have the taxpayer name, which is your company, printed beautifully across the gift. Okay? You can put it on there. You can put it on a cutting board. You can put it on a picture frame. You can do a decorative something, and you can put it on there. And you could be supporting another small business as well. So there you go. Two people get some benefit. Another small business is benefiting from your purchase and your engraving. And you will be able to deduct. You can actually, it doesn't count towards the $25 limit. So you have two things. You can give somebody a $25 gift. And if you put your name on it, permanently imprinted on the gift, okay, it will not count towards the $25 limit. Wow. There you go. You have a deduction and you have a gift that you can give to your customers or your business associates. Now, self-employment tax deduction. Everybody's responsible for paying Social Security and Medicare contribution. Everybody's responsible for paying that. But what the government gives you as a self-employed person is the ability to claim half of that payment as a deduction. So as an employee, I pay my share of taxes out of my payroll, and my employer pays the other share of the taxes out of the payment that they receive from their revenues, goods, and services. And they apply that to my share of the amount of Social Security and Medicare that contributions that has to be paid by the employer. Well, if you're self-employed, you're both the employee and the employer. So the federal government allows you to claim 50% of that employment tax. That would be the employer share that you can deduct. So keep that in mind. You get to claim 50% of the self-employment tax. Business travel. A lot has been up in the air about what actually is covered now with the Tax Care Job Act. Okay, what is now available? What can you do now when you take a trip? It's quite lengthy, and not only did I provide you with some of the information, I provide you with the notice that will provide additional information on these changes. So here's what's covered. The cost of getting to and from your destination. So that means if you drove to the point and you're tracking your mileage, that's covered. If you flew, that's covered. If you took a ship, that's covered. Well, don't take a very fancy ship, okay, because then that's going to be questionable. But it's the cost of getting to and from your vacation. Any related business expenses that you incur when you get to that destination is deductible. Everything else but entertainment. So if you decide, excuse me, so if you decided to go to Las Vegas for convention, you can cover the cost to get to Las Vegas, your hotel room, your meals. You cannot cover the cost of those tickets to the live entertainment or to the not so live ones, just in case they have something else like a movie theater or something. Those type of entertainment expenses are not allowed, but you can cover the cost to get there, any business related expenses, your meals, your hotels, your rent a car, whatever, you can cover those. Okay, meals are deductible when you are away from your tax home and you're working on site. For a lot of you who are out on the disaster sites, you need to hold on to your receipts because those meals are tax deductible if you are not living in that area where you're working. So if I left from New Orleans and went to Lafayette to work the disaster, the expenses that I incur while I'm there, such as my meals, are tax deductible. If you're a contractor and you travel all over Louisiana doing work, you know, those meals expenses are tax deductible. Your overnight stay is also tax deductible. If you stay in a hotel, that is deductible as well. Now, here's something that's important. Suppose you're traveling for your job, okay? And you've got to your destination and you have to stop and rest. You may not have spent the whole entire night, but you have to stop and rest somewhere so that you can perform your duties. That part of the expense is tax deductible. Okay, that part of the expense is also tax deductible. Now, only 50% of your meals expenses are deductible. Lodging expenses are deductible 100%. Keep track of your receipts. Keep track of the miles that you're driving because those miles are deductible as well. But I don't want to get ahead of myself, so let me focus on the meals. Meals, 50% of the cost of business meals are deductible if, notice the caveat, if the taxpayer or the employee of the taxpayer is present and the food or beverage are not considered lavish or extravagant. So yes, 50% of your meals are deductible, but don't go overboard. Don't go over there buying what they call the snail, whatever they call the snail. I can't remember. It just went straight out of my head. But anyway, don't go over there but living an extravagant, lavish life thinking that, okay, you can write off 50% of it. That's not allowed, okay? The meals that you are providing to your current or potential business customers, clients, consultants, similar business contact, that's allowed. You can deduct 50% of it. And if it's provided during an entertainment activity, please note, this is important. If you got your meals and beverages during an entertainment activity, the food and beverage must be purchased separately from the entertainment, or the cost of the food or beverage must be separately stated from the cost of the entertainment on one or more bills, invoices, or receipt. So you cannot pay $50 for all you can eat, drink, and be entertained and think that the government is going to say, we'll accept it. You'll have to have an itemized bill showing what you ate, what you drank, and this is the cost of entertainment, because only the cost of the food and the drink would be allowed as a deduction. Well, we covered a little bit about benefits to employees, but let's talk about deducting health insurance. The cost of personal health insurance premium as a self-employed person is deductible. Yes, please go get medical care, because it is deductible as long as, number one, the business has a profit. Listen, I can't see as any other reason why you should want to have a profit other than to be able to have access to health insurance. Deduction, the deduction for health insurance. So if your business is claiming a profit, then you can deduct the cost of the personal health insurance premium. If you have a loss for the tax year, it's not deductible. You cannot deduct health insurance premiums against a loss. Okay, it's a benefit to you if you make money, but you can't go digging a hole any further if you did not make any money. Another thing is that you're not eligible to enroll in the employees. Another caveat to that is that you can only deduct the cost of personal health insurance if you are not eligible to enroll in an employer's health plan. So if your spouse is working somewhere and he or she has access to an employer's health plan, you can't decide that I'm not going to enroll in his or her health plan because I want to take it as a deduction on my business expense. It doesn't work like that. If your spouse has health insurance, jump on the bandwagon and tell her, sign me up, honey, so that I can go to the hospital, because the IRS will not allow you to pay for your health insurance premium if your wife, your spouse, your husband has access to health insurance premium on the job. Please remember that. Okay, and you can only claim premiums for the month that you were not eligible for the employer's health plan. So in this situation, your wife did not have, both of you are running the business, and somewhere around June, things was getting tough. And one of you said, okay, I'm going to go get a job to help things out. But of course, when you go get a job, the first time on a job, they give you so many days to sign up for health insurance. You can only claim the premiums for the days that neither of you had health insurance. The minute your wife became eligible and paid for that health insurance plan, you will no longer be allowed to claim the premiums on your business as a part of your business expense. Remember that. You can claim it if you have a profit. You can claim health insurance premium if your spouse is not working a job that provides health insurance. But you cannot claim it if you're not making a profit, or your spouse has access to health insurance on the job, and for some reason you have decided that you will not be taking that insurance. That's just not a smart move, buddy. Transportation costs. Well, we've talked a lot about what's allowed, so let's talk about what's not allowed. You cannot deduct the cost to commute between your home and the place of business. So if you're traveling if your place of business is in Laplace and your office is in, let's say, Baton Rouge, you cannot deduct those miles between Baton Rouge and Laplace and Baton Rouge. But here's what you can deduct. You can deduct the mileage that it takes for you to go to Lowe's, to the supply stores to pick up supplies. If you're going to have a meeting with a client, you can deduct the mileage going to the meeting. You can deduct the mileage attending a conference, anything else but going from your house to your business. So if you're tracking your miles from the time you leave, get to your business destination, if you're tracking your miles, the miles that you have traveled throughout the day from that point until the end of the day when you get back to your business destination or to your home, those miles are allowed for deductions on your taxes. Notice I say miles. And that's important because you have to choose and stick to either actual vehicle expense or standard mileage. It is so important that you understand you can't have both. You can't deduct your gasoline, insurance, maintenance, depreciation, and lease payment on your taxes and still take standard mileage. You can't have both. So you have to choose which one of them you're gonna take. And I provided you with the current mileage for this year. Businesses, if you're counting the miles for running, taking trips throughout the day on behalf of your business activities, then that's 5.575 cents per mile. And if you're charity, it's 0.14 cents. And if you're into medical moving, then it's 0.17 cents. I want to acknowledge the different types of and so those are the three categories that the federal government has identified and applied a standard mileage rate to. Okay, so remember, you cannot have both. And please, one of the things that happen is that when you're jumping from one tax preparer to the next, you kind of forgot what option you gave to the other person. So you may have went to Jackson Hewitt and say use actual, and then you go to Liberty Mutual and then say lose standard on the same vehicle. Guess what? The federal government, it all goes to one place, the federal government. So stick to one option, either actual vehicle expenses for that vehicle or standard mileage method for that vehicle. Some of you have many vehicles, you have a fleet. Keep track, keep a log of what you have, right, by VIN number, by license plate, make and model, and include a column for tax method applied, and that would be either actual vehicle expense or standard mileage vehicle expenses. Depreciation. When most people think about depreciation, they think about the depreciation on the equipment, the equipment they buy, the depreciation on their furniture, your computers. That's a full write-off right there. Most people don't think about the software that they buy to put on the computers. That is an asset to you, and of course, it is also fully written off through the use of depreciation. Most people don't think about the cost that was incurred to install that asset. To install the software. Most people don't think about the cost that they incur to install the software on the computer or to tailor the software to meet their business needs. All those are costs that are capitalized, meaning that they're added to the asset value of the software. So when you go out and you buy PeopleSoft and you have to get somebody to modify PeopleSoft and reprogram it for your use, the cost of that person plus the cost of the software that you paid for the software now creates a new value for that software. It has to be capitalized and then it has to be depreciated. So here are the rules. Business owners are allowed to write off 100% of new purchases for computers, furniture, equipment in lieu of depreciating the asset over its useful life. That means you don't divide a computer by 36 months to depreciate it. That means on your taxes, you depreciate it immediately. If you paid $700 for it, it depreciates immediately on your taxes. This is called bonus depreciation. Here's what you need to know about bonus depreciation. What's the first line? No annual limits on deduction. There's no limits. The deduction isn't limited to your cost. That's a big difference between Section 179. And a lot of people are aware of 179 because Section 179 also allows you to write off a lot of expenses. However, there is a limit on Section 179 that is not on bonus depreciation. So the first thing is to recognize about bonus depreciation is that it is different from the 179 depreciation. It's two different things. There's no annual limit on the deduction. That means it's not limited to your cost, and you can deduct the entire investment no matter how much you spend per year. So if we put that in perspective of buying a vehicle, and there is a list out there with all the vehicles that are eligible for this type of deduction, that means you can expense the entire vehicle cost, even though you're still making monthly payments on it. Yes, that is the tax law. That is the tax law. And if you don't believe me, at the end of this, I give you all my links so you can do your research yourself. Another benefit of the bonus depreciation is that your deduction can be greater than your business income. That's a stark difference between the Section 179 because the Section 179 deduction limits how much you can take. The Section 179 deduction cannot be larger than your annual business income. However, the bonus depreciation does not have that restriction at all, okay? So that means you can carry any unused deduction forward as future tax break. I don't know if anybody else get goosebumps when they talk about this stuff but me. But from my perspective, I look at it this way. There's a limit and there's a future. So the limit is, hey, if you take 179, you're limited. You can't take a deduction that's bigger than your business income. But if you take the bonus depreciation, you don't have any limitation. You don't have any limitation as to how much you can take this year because whatever excess you have rolls over to the next year and can be applied to your future tax years, okay? If you're not excited about it, I don't know what else to do. I really don't know what else to do, okay? This is the bonus of the depreciation, and this is the bonus of the tax break. Another thing you need to know about bonus depreciation is less flexible, but it must apply to all assets. So with Section 179 deduction, your bonus depreciation must apply to 100% of your asset cost. And all of your assets must be in the same category. So if you have equipment, so if you went out and you're in the field of grass cutting, you went out and you bought lawnmower, weed whackers, you bought the big old things that you pull and drag to cut the grass and all these different things. The 170, the bonus depreciation must go towards all of those assets, costs, in that category, okay? If you use your bonus depreciation for one 5-year asset, you will need to use it on all of the 5-year assets that you bought that year. You cannot pick and choose which asset you want to put the bonus depreciation on. You have to apply to all of the assets that meets that same categorical label. This is equipment. If it's equipment, the equipment depreciates over 5 years. All of your 5-year assets, all of your 5-year equipment all of the equipment that are depreciated over 5 years must receive that bonus depreciation. Section 179 is a little bit different in that it allows the business to deduct the full purchase price of the qualifying equipment or software purchased or financed during the tax year. So that means if you buy or lease, and believe it or not, some leases are depreciable, So that means if you buy or lease a piece of equipment, A, meaning one piece of equipment, you can deduct that full purchase price from your gross income. So whereas the bonus depreciation says you got to apply to all of the assets in that category that's depreciated over the same period of time, the section 179 says, hey, you can pick it, you can apply that 179 deduction on that particular equipment or software, okay? And then we'll apply to that particular item and deduct the full purchase price from your gross income. There's a caveat though, okay? There's a caveat. Everything else will always have a caveat. It's never just, hoo-hoo, let's run with it, let's go crazy. There's always a caveat. The caveat is the amount of assets you can deduct the first year on the section 179 tax break is $1,020,000. That is the most you can deduct. I'm sorry, guys. I am so sorry. What's even sadder is that if it's a sports utility vehicle, you're limited to $25,500. There is no way in the world any of you could be happy with such a decision. And I'm really being cynical. I'm really being, I'm not really serious because honestly, $1,020,000 is a lot of money. And if you are upset that you can't deduct an asset for that amount of money, then go add the bonus depreciation to it, and then you'll be even happier. So if you're happy about it, please just, if you're in the chat group, go ahead and, you know, shoot some fire lights or some kind of fireworks or something in the chat group. So I can know that you're really, really happy about the fact that you have two of the greatest deductions available to any business owner who's purchasing equipment, cars, software that has ever been known to man. And I don't know too many people who will exceed that amount on the 179, except you're buying of course, a sports utility vehicle. So let's go over the differences between the bonus depreciation and the section 179 depreciation again. The annual limit on the deduction. The maximum section 179 deduction per year is 1 million. You cannot deduct any more than 1 million, please, okay? You cannot deduct any more than 1 million. That's what the IRS says. If your business spends more than 2.5 million on a piece of equipment, the amount you are eligible to deduct starts to decrease. So don't go buying a $2.5 million equipment and say, I am going to get even a bigger deduction. You're not, you're going to get less deduction. This is to help you to control your spending urges, and this is to help you think critically about your spending and how you're going to use the different bonus depreciation and section 179 depreciation. There's flexibility with timing. You can choose which purchase to cover over the 179 deduction and which one to save for the future. So you don't have to use your 179 deduction right away. You do not. You can split the deductions for individual purpose. You can claim half the cost of the new car this year, and then you can spread the remaining cost of the new car over time. So if you went out and bought a $1.5 million car, and in section 179 say you're limited to $1,020,000, then you can split that deduction. You can split it. Take some now and take some later. So don't be greedy. Section 179, it says you can use the section 179 deductions for real estate upgrades, such as adding a new roof to your building. Woohoo, I'm changing my roof right now. Okay, I'm just kidding. You can add a new roof to your building, and that will be considered a deduction for real estate, and you can get the whole cost deducted. Bonus depreciation does not cover real estate. So here we go. You have to understand when you can use a 179 versus a bonus depreciation. They are two different things. but the range of depreciation, the dollar value that you're allowed to apply to this depreciation is phenomenal. You can use both of them. You just have to use them wisely. Oh, I guess I spoke too fast. Yes, you can use both of them. You can use them both in the same year, but I will always tell you, I'm your presenter. You must have a good accountant. That's the first thing I covered the first time. The first week I said, go get you a good accountant. Go get you a good CPA. Go, if you're making a lot of money, you should have a CPA and a good accountant or management analyst. Forget accountant, have a management analyst. And you're supposed to have a tax consultant, somebody who specializes in it. There is no way you should be making a lot of money trying to wing it yourself and going to the other people who don't have money goes to. You need to go and spend that money in a high quality area and get the best bang for your buck from people who are constantly studying the tax laws. And again, I just give you the link. I like to give people a link. I will go find the link if I don't know it. And that's what I did. Went and find all the links I could to give you a point of reference. Okay, the benefit of these deductions is that the increase in deductions help the business owner to reduce taxable income. And you can spread those things over multiple years, okay? Self-employment and income tax liability. That's one of the things that these deductions help to reduce. Remember, if you're self-employed, you still have to pay self-employment taxes, not just for you, but for the company. Only thing I would say, speak to someone. Go speak to a Social Security representative. There's some who are independent and there's some who still work for Social Security. And ask them to tell you how does reducing your taxable income and self-employment income and tax liability, how would it affect your Social Security and Medicare? You always want to find out what the effect is going to be on the long term. And then you need to find out how do you address it, okay? Everything has its pros and cons. Your goal is to figure out how to make it apply to you the best way and how to make it apply so that it doesn't hurt you in the future. Number 12, retirement plan deductions. Hey, if you're a business owner, there is no reason why you should not have a retirement plan. There's so many options out there for you right now. There's a 401k, there's a simple, there's the SEP IRA, the simple IRA, the IRSS. There are so many retirement plans out there for you that you can take advantage of. Do not sacrifice your future lifestyle for the sake of the present. And what I mean by that is do not set up a retirement plan. Do not meet with a financial advisor and learn how you can structure your whole business, your finances and everything so that when you get older, you have something set aside, okay? Tax credit is allowed is equal to 50% of the first $1,000 incurred in starting up the plan. And always remember, if it's an IRA, a 401k, you get to put pre-tax money into it. So not only do you get to put pre-tax money into some of them, you also do get to give some of your benefits to your employees. That's another deduction. And then you also get to deduct the first 50% of the costs incurred in starting the plan. And I gave you a bunch of links with this one because I want you to go do your homework. If I could do a whole week of sessions on this topic. There's just so many things out there when it comes to your retirement. I want you to make the right decisions. I want you to explore your options. Don't be that person who lives for now. Keep in mind that there is a future ahead of you. Now let's talk about startup costs. I left that for a little bit further down the line because I'm hoping that by the time you've heard all these wonderful things about tax deductions and how taxes can be beneficial to you, not just this year, but next year, that you would stick around long enough to hear about how to handle your startup costs in your business. New business are allowed to write off about $5,000 worth of startup expense. And if your startup expense exceeds $50,000, then you have to consider amortization of the cost. Amortization is like is a depreciation. It's similar to depreciation for expenses. Um, it's similar to depreciation for equipment, I should say. So when you're amortizing startup costs, these are costs that are incurred with maybe research and development, maybe starting a business, something new. Those costs after a certain dollar value has to be amortized. So that means every single year, it's almost like a depreciation those costs. Similar to when you buy equipment, you take depreciation each year, except of course if you take the bonus depreciation or the 179. So your startup costs, track all of your startup costs. Sometimes it takes you 2, 3 years just to get going. So what are the costs you're incurring? You might be meeting with a business advisor. You might be meeting with a marketing strategist. You might be meeting with someone who will help lay out your whole plan, your business plan. You may be meeting with someone who's helping you set up your accounting system in advance of your actual start date. The cost that you're paying for registering your businesses, your license, all these different things, all these different costs are part of your startup costs, and you can deduct them if they are $5,000 or less. But if they're much greater, then you have to amortize them. Keep your receipts for everything you do concerning your business. Please keep all of your receipts. There's no business expense that is inconsequential, that's not beneficial to you. So we just talked about it. Examples of startup costs. If you had to hire somebody to do some research for you, then that's a startup cost, okay? Advertising for a new business, travel costs to go meet with someone else so that they can talk to you more about your business. You're going to open a store. You may need to travel to Timbuktu to go meet the supplier. All these are costs that's associated with getting your business up and running. One of the things that I'd like to urge you to do is to make it easier on your accountant or even on yourself. Find an accounting software that will allow you to snap a picture of the receipt and it automatically uploads it into your accounting system. I know QuickBooks does it. I know there's several other things out there. I don't get paid to push QuickBooks. I just put QuickBooks out there because most of you use it and most of you use it terribly. But I have faith in you that you will find really great help to get it all fixed up. But I just want to say to you, please scan your receipt into a software that will move it directly into your accounting system. And all you have to do is get with your accountant for them to assign it to the proper general ledgers. Remember, every transaction must have 2 entries. So make sure it's being assigned to the proper general ledgers, and it'll make your life so much easier later on where you're not trying to do like me sometimes that I do, leave everything in a bag and then have to sort it out and push it into other categories and produce a miracle by tax deadline. So please take advantage of what's out there, technology. Understand that you do have choices when it comes to setting up your business. You do have choices when it comes to buying equipment for your business. Just make sure that when you get a cash saving that you use it wisely. Don't just spend it. Just if you have a cash savings on your tax and you get a cash refund, use it to buy an equipment or use it to pay down the equipment that you just bought, okay? Home office deduction. A lot of you have work from home, and a lot of times people tell me, I want to go own an office. Oh, I want to rent an office. I think that's what people should do. Normally, I tell people all the time, if you're not going to be in that space for at least 12 hours a day, you don't need to be paying for a rented space. IRS tax code allows you to have a space in your house, not even a room, a space in your house where you are conducting your business. It could be a space that's 3 by 5, and you have all your shelves, you have your filing cabinets there, you have your computer there, you have a little motivational quote right there, you have an extra chair where you meet people. It could be in your kitchen, it could be in your living room, it could be a spare bedroom, whatever it is. The IRS allows you to deduct not just for the square footage space, as though your business is paying rent. That's what it's like. But it allows you to deduct portions of utilities, rent, mortgage interest, real estate tax, depreciation on the house, cleaning fees. Hello, ladies, come on. Y'all need to start hiring cleaning people, cleaning fees, any allowable home-related itemized deduction. So if you went and you bought a case of pop, just in case you have a client come over and you buy a case of 24 and you buying one of those every month, because if you have children, they're guzzling those things down. But you know you meet with clients at least 5 times a month, and at 5 times a month, you offer your clients something to drink. Oh, by the way, you guys call it a cold drink. Down here in the Midwest, they call it a pop. Okay, some places they call it soda. But if you know that every month you at least offer a client, one of your clients, a drink at least 5 times, 5 of those pops can go to your office expense. Yeah, 5 of those. Water, 5 of those can go to your office expense. What I'm trying to say to you is that any home-related itemized deduction that is utilized for business purpose, you have to track it. It's all about your record keeping. That is used for business purposes. It's tax deductible. So that means when you meet with a client, you may have them sign in on a book, put a date and a time that they leave. But frankly, people really don't care no more. They don't need to go see you at an office space that's only open when they walk in. They just need to have access to you, and you just need to understand that portions of your home are tax deductible, and you need to utilize those tax deductions that are available for you. Well, one of the things that I noticed is that before, I used to plug it all up into my my tax software. My tax software would spit out the value of the expense deduction that I get. But the IRS have came up with a really simple method of calculating your home use for business purposes. And that is multiplying the area of your home by $5. The maximum amount that you allowed is $1,500. That's the maximum, $1,500. So don't leave that $1,500 on the table. Another thing, we're coming close to the end of it. I'm not really keeping track of the time like I should. I'm passionate about taxes, and so I tend to lose track. Let me check my time. Okay, almost finished. All right, so the other part of it is that the small business who report their business income relates to the small business who reports their business income on the Form 1040. A sole proprietor uses a Schedule C, income from partnership that rolls to the tax form 1040, S Corp income that rolls back to your tax form 1040, LLC income that's reported back on your tax form 1040. You automatically get a 20% reduction before you are even taxed. Did you know that? That's because everything happens so quickly in the background. You don't even know that. So when you report your income, your business income on a 1040, you automatically receive a 20% deduction before your tax rate is applied. I just want to let you know that that's a wonderful thing. You're getting it. You don't know it. Now you know it. There's something to be grateful for. So this 20% benefit allows a small business to keep more of its earnings tax-free. That's what it's for. You keep 20% more of your earnings tax-free. It also prevents you from going into a higher tax rate, okay? And the 15.3% self-employment tax, it helps you there as well. It also reduces your marginal tax rate. what you need to understand about your marginal tax rate is the rate at which tax is incurred on additional dollar of income. So if they're reducing your income by 20% up front, you are not going to be, that's 20% of income that you're not being paid, that you're not being taxed on. Okay, and the marginal tax rate increases as your income increases. So that's 20% of the income that's not being taxed. And so that effectively, it lowers your tax rate from 37% to 29.6%. And I do get, again, the link is here. You can read the whole book if you want to, but I just want to let you know that this is something that takes place behind the scene. You don't even see it. It's seamless. As soon as you put your figures into the system, the first thing they do is take 20% off your income and they tax you on the rest. There is a limitation. One thing to know about taxes, there's always a limitation. And the limitation on this 20% tax is that it phases out for single filers and married filing separately at $160,700. That's sad. So if you are making $160,000, you might be mad that after $160,700 it phase out. But you know, for some people, they might be just happy that they get to keep $160,000 before they start losing the benefit of that 20% deduction. So my question to you today is, do you want, number one, to experience the joy and benefits of these tax deductions? I don't know about you, but I love getting my income tax money. So do you want more deductions? If you do want more deductions, I am suggesting to you that you do some research. I am providing all these links here. I'm providing all those links that you see that you'll be getting, and just so that you can learn more about how you can utilize your taxes. Stop trying to go for broke on your financial statement. Stop trying to constantly have a negative financial profit. It's not even a profit, not a loss, because you can't get a loan from the bank. Who's going to lend you money when you can't even manage your own money? Who's going to lend you money when you can't even share a profit? Instead of trying to go for broke on your financial statement, learn what benefits are available to you. I've given you so much wealth of information right here, things that you can do. I've given you so much of this to stop you from going for broke on your financial statement. Use the bonus depreciation. Go buy yourself an equipment. Stop leasing those equipments all the time. Figure out which one you're using the most and go buy it. Okay? Use the section 179. You have to earn over $1 million to not be able to use it. Please use it. Okay? And in this link, the last line on this page right here, Square Milner, it provides a list of all the equipment you can purchase. All of them you can purchase and still be eligible for the 179 deduction. There's an Audi on that thing. An Audi, okay? So I'm not telling you to go live large, because you still have to buy the gas, you still have to maintain, you still have to do all the things. But I'm telling you, treat yourself to good living by doing the right thing, filing your taxes properly, keeping good financial records. And yes, I am going to send you the link. All they want is the link. They don't want a presentation. They just want the link. Okay. So yeah, I'm looking at them right now. So how many? Okay, it's not a whole lot. I have Dina Perkins. Yes, I don't think I'm gonna eat snails anytime soon, but a lot of people do think it's fancy. It is a lot for the average mom and pop. But the reason why I'm doing this class is because I don't want you to be the average mom and pop. I want you to see yourself as a true business person. And part of it is the financial record. Stop treating your businesses as a piggy bank, as a cash register, not even a piggy bank, as a cash register. Um, Set yourself a budget, pay yourself a fixed amount of money, write a check to yourself, deposit it in your own account. Here's what I forgot to mention. This was important. If you keep using your business account like your personal account, you lose the protection of an LLC. An LLC was designed to protect you. And if you go swiping your business card at the at the casinos or McDonald's or doing all this kind of stuff, you lose the protection of your LLC. That means that when somebody decides they want to sue you, they just got to dig further, dig into your bank account records, and then they're coming from your house and your personal assets. So please, it might be a lot for the average mom and pop, but if you begin to structure your stuff like this, you will be fine moving forward. Somebody, Diana said, yes, yes, yes. Angelique, Angelique, okay. Angelique, you can get the list. You will get the link like everybody else and the presentation. I would like personally to put all the presentation in one package and you get it all at one time. If this is okay to you, that's fine. If it's not okay to you, then it's not fine, but it's still okay for me. All right, guys. Thank you so much. It was my pleasure being able to present to you. I really want to see you succeed from the bottom of my heart. And I wish you much success in your business. Again, my name is Benita Rice. If you need to speak to me, I know I haven't given you my number. I know I haven't given you my email address, but I'll provide all that. If it's okay with the library, I can provide that at the end of the program. All right. Thank you all. Have a nice day.